This warehouse holds millions of identical boxes. Whether this stockpile is an asset or a liability depends entirely on how a company calculates its valuation. The exact value of this closing inventory is the deciding factor in whether a company's financial reports reflect its actual performance or an inaccurate fabrication. By artificially inflating the value of these unsold goods, a business manipulates its perceived income, making its financial position look significantly stronger on paper than it is in reality. We see this in the cost of goods sold equation. Costs equal opening inventory plus purchases and direct expenses minus closing inventory. Because it's a subtraction, a higher closing inventory shrinks your reported costs, driving up reported profit. Precise inventory valuation acts as a defense mechanism, ensuring the balance sheet is grounded in reality. Before assigning a value, we have to define what legally qualifies as inventory. This includes assets held for sale, goods currently in production, and materials consumed to produce them. A standard trading company has a simple inventory of finished goods and packing supplies. A manufacturing company, however, manages a much more complex pipeline. In this pipeline, raw materials transform into work in progress before becoming finished goods, all supported by factory consumables. But a strict exception exists. Machinery spares and standby equipment are not inventory. Being tied to specific assets, they are fixed assets. Categorizing these physical assets correctly is the mandatory first step before any monetary valuation can begin. Tracking the physical quantities of these items across a global enterprise requires a choice between two primary systems. The periodic inventory system relies on a manual physical count of the entire warehouse, a reality check typically performed at the very end of the year. Under the periodic system, the cost of goods sold is a residual figure. It can only be determined after the physical count reveals the final closing stock. Most modern businesses use the perpetual inventory system. This method uses continuous digital tracking, recording every item the moment it enters or leaves. In perpetual tracking, the cost of goods sold is known in real time, making the closing inventory figure a simple balancing calculation within the ledger. While the periodic method looks backward at what remains on the shelf, the perpetual method tracks sales as they happen. Counting the boxes is the first challenge. Pricing them is the second. If the market value of your goods drops below what you paid for them, the accounting rules change. The golden rule of inventory: it must be valued at the lower of its historical cost or its net realizable value. This principle of conservative accounting demands that losses be recognized immediately, while potential gains are deferred. This strict requirement prevents false optimism, forcing businesses to confront anticipated losses as soon as market values drop. Before we can compare cost to market value, we have to determine the cost itself. This depends on whether the items are unique or interchangeable. Bulk goods are considered interchangeable, while high-value, bespoke items require a different approach. For unique items like high-end medical equipment, companies must use the specific identification method, tracking the exact cost of each individual unit. For interchangeable goods, the decision tree branches out. Businesses can use historical cost formulas like FIFO and weighted average, or non-historical methods like the adjusted selling price. Let's apply this to Sareka Ltd., evaluating 3 distinct products at the end of its financial year. Product P's cost is 38, NRV is 42. We select 38. Product Q's cost and market value are both 29. Product R's NRV dropped to 14. We recognize this market loss immediately, bringing the total valuation to 81 lakhs. This item-by-item approach ensures the final balance sheet is never inflated by overvalued stock. Returning to our warehouse, we see that every pallet of goods represents a meticulously measured current asset. We have established the 3 pillars of valuation: the COGS formula, the perpetual tracking system, and the principle of prudence. However, a problem remains. If a company buys raw materials in January for $10 and again in June for $15, which cost do they apply when they sell one item in December? That chronological pricing challenge is solved by the mathematical mechanics of FIFO, LIFO, and average pricing. Mastering these valuation techniques ensures that a business's reported performance is backed by absolute financial precision.